Welcome back to It's Down to Business with Jack Miller. Call us at 305-541-2350. Follow us on Facebook at Jack Miller Down to Business or on Twitter at H.Jack Miller 1.
You have chances to serve much more than you grab the...
Hello, everyone. This is Jack Miller with Todd Cohen. Todd, I thought Susan Bennett was fantastic.
Oh, my God. It's so hard. Like, I keep picturing my phone when I hear her voice, even though I saw the pictures on the website and whatnot. But that is just a fascinating job, a fascinating woman.
And I didn't really even get into all of her things. Literally, I have a list that I got from her website of jingles she's done, companies that she's done work for. Unbelievably talented. Just,
right.
I have no talent, so when I talk to someone like that, who happens to appear to be very nice and humble.
I was going to ask her if she actually used Siri herself when she uses the phone. I forgot to do that. And is that weird?
You know what? You're right. You know what? We'll put it on Facebook and Twitter. She'll respond to it. I'll get her to respond to it. Anyway. So now you're ready to talk some out of Siri back into real world.
Yeah. Look, I would like to talk real estate.
Let's talk real estate. You know what? Let's talk, Todd, not only real estate. Let's talk how you make money in real estate, cap rates, rate of returns, IRR. I think people sometimes get confused by the measurements we use in real estate, or it could be other investing. So You want to talk a little bit about that?
Look, I mean, global markets have sort of melted down a little bit over the last month. The stock market had a bang-up start to the year, losing about 10% of its value. There's a lot of uncertainty with oil. One thing I know is having a tangible asset that, provides cash flows is something that really can create and protect wealth. I'm an advocate for real estate as an investment, and I think now is as good a time as any for people who don't own real estate to think about it, and for those who do, to either improve their positions or take larger positions in what they own.
I agree. So let's talk first, before we get into some specifics, let's talk the measurements of real estate.
Yeah, I think that's
keywords.
Great.
What's a you hear all the time cap rate or capitalization rate. Maybe give our audience a definition of it and how you measure it. And then we'll talk about the 3 or 4 measurements and how they relate, and how one may be good for one investor but not good for a different investor's goals.
Right. I mean, real estate has its own real estate talk or jargon, like anything else, like legalese for lawyers and whatnot. One of the key metrics is a cap rate. You hear it all the time. Where did that deal trade? What cap rate did you buy it at? And what that means is that's the yield that the investor should expect to receive, day one on their investment.
Let me back up. Leveraged or unleveraged?
Okay, so a cap rate is always in unleveraged speak.
So let me break it down. So if a property's $1 million,
okay,
and
you buy it at a 7 cap,
okay, 7 cap, that means that I'm going to get $70,000 a year,
and it also means that that's a 7% yield on your investment
without leverage.
Correct. On that $1 million, assuming all cash.
If I write a check for $1 million, I get $70,000 back. That's a 7% cap or 7% yield. How does leverage affect the cap rate?
Well, it depends how much leverage you put on, but it doesn't affect the cap rate. It affects the yield.
Yeah.
And it affects your return. It affects your cash-on-cash return, which is really, look, let's talk about it in terms of what it really is. It's your return on equity that you would be looking at. So if you buy that same property for $1 million and you put a 60% loan on that, you're only putting up $400,000 of equity, okay? And if you get that same 7% return unlevered, so you're getting $70,000, you're now getting that $70,000 over your $400,000.
But you have a mortgage to pay.
Correct.
To pay on that.
And then it's less the mortgage you pay. So let's figure it's accretive in today's market where you can get somewhere in the 4 to 4.5%. For the sake of this conversation, let's talk about interest only because it makes it easier. So let's say you get a 4% interest only loan, okay? Yep. So your interest only now on the 600 is you're paying $240,000 a year, okay? Or you're paying $2,000 a month of what you're doing, okay? And what you're getting is $70,000. I'm sorry, it's $24,000 a year and $2,000 a month. and you're getting $70,000 in cash. So what you're left with is the $48,000. This is going to get convoluted, but at the end of the day, it's accretive. So you'll be earning a better return, cash on cash, than you would in the other scenario.
So if you put on more debt, let me say it in my more street language, if you put on debt, a reasonable amount of debt on the property, and the interest rate you pay on the debt is lower than the cap rate, it will push up your yield, your cash yield.
That is exactly right. And leverage is, you can imagine like a lever. And a lever, you use a lever to sort of lift something up. And when you employ leverage, if you do it prudently and, effectively and efficiently in the real estate world, you can really add a pop to what you're getting in your investment on a return on equity basis.
So that's a cap rate, and what's the next measurement?
So I want to explore return on equity a little bit more, okay? Because, over the last 15 to 20 years, we've had a huge surge in real estate prices. So one of the things I do for my clients on a daily basis is we sit down and we do a return on equity analysis, okay? So if my client originally invested $1 million into a shopping center, okay, 10 years ago, let's say.
Yeah.
And today, that same shopping center is worth $3 million, okay? They still only invested the $1 million. But their equity position, if they bought all cash, is now $3 million, okay? And let's say they were earning $100,000 per year as their cash return, their yield, okay? On that $1 million, that $100,000 would be a 10% return on their investment. But over time, that investment has accrued equity.
It's appreciated.
Correct. And now it's worth $3 million. And so that $100,000 in over the $3 million equity position is really only about a 3 1/3% return. And you could do better. So what I talk to my clients about a lot of times is we look at that kind of thing and say, look, your equity's trapped here. Your $1 million is trapped. It's worth more. You could be getting a higher cash flow from that. Okay?
But let me back up.
You can do that two different ways. You can sell your original thing now for $3 million and go buy a $3 million property that pays whatever percent you can find. Or you can go to Jack Miller, potentially, and you could, refinance the property or finance it for the first time.
Take more leverage.
Borrow money, take it out, and buy a second property.
And that has some deep tax implications, so I don't want to get involved with the tax implications.
Well, we're not CPAs.
No, but how often, because I think owners of real estate, especially who've owned them a long time, I don't want to say make that mistake, but overlook that. They'll use to your scenario and say, okay, I put $1 million down, I'm making $100,000, I'm happy. And maybe their $1 million is now worth $3 million.
Okay.
So I think they have to reevaluate their holdings periodically.
I think everyone should.
Yeah.
I think if you go and buy a mutual fund, every quarter you're going to get a statement that shows what your cash position is mark to market. I think people should evaluate. I'm not saying that you need to do it quarterly, but certainly once a year. You should look or have a real estate professional help you with an appraisal or some sort of broker's opinion of value so you can understand, where your property lies, in the gamut of other properties like kind in the market.
Gotcha. So that's your return on equity.
Correct. Now, another thing we can look at is the combined, which is the return on investment. Okay. And that's if you do employ, leverage, what's your overall return? And, that includes the return of the overall investment and the cash flow. So if you buy a property for $2 million and you get a 50% leverage, you're still looking at your return on the $2 million property. Okay, it's not just the return on the equity portion.
We're simple. I just want to give a disclosure here. We're simplifying it. We're not putting in. We already mentioned tax implications.
Sure, there's closing costs.
There's depreciation.
There's leasing costs. There's depreciation.
Yeah.
Everything that.
That's
you can
why
do.
they need an expert
CapEx,
like you.
Sure.
To figure out. Okay, so what other measurements of?
Well, one thing that I was thinking about, some people probably heard the term IRR.
Yes, I was going to bring that up.
Which is an internal rate of return. A lot of times this is employed by people who don't necessarily need stable cash flows, okay? And what an IRR does is it looks at the overall investment. It looks at the cash outlay in the beginning, what you pay for the property, and then all of the staggered cash flows along the way. And sometimes they're positive, sometimes they're negative because you're fixing up the property or developing an out parcel on a property or, doing some sort of leasing. Sometimes your cash flows are positive. But overall, and then it also looks at the sale of the property down the line. Let's say it's a 5-year hold.
You mean the time horizon?
Sure. And then everything is discounted back to today, okay? So the internal rate of return assumes that a net present value of 0 is made. And what would the return be to pay, let's say, $3 million for a property today? And then let's look at cash flows in the first year of $10,000, the second year of $100,000, the third year of negative $200,000, the fourth year of $80,000, and then finally selling it 5 years from now at, let's say, $4 million.
So
what would the internal rate of return be? So
when you do an internal rate of return or an IRR, you and your professionals do it, you need to make some assumptions.
Of course.
And I would suspect you have to constantly update those after you buy the investment.
Of course. And one of those assumptions, obviously, is what your cost of capital is and how you do that, how you get to that. It's sort of some sort of delta over the risk-free rate at some time. You're going to look for, over the time horizon, what you really believe the cost to borrow money is. And so you'll use something probably higher than today's interest rates as your discount rate.
Mm-hmm. In an IRR assumption, I assume you can build in any potential refinances or things like that.
Of course. All costs are assumed, all finance, all leverage is used, everything.
Todd, I feel bad. We got to take I feel bad for everyone. I feel bad for you. We got to take a quick break to hear our word from our sponsors. When we get back, I want to talk about a little bit more of how these different matrices, first of all, how you can how people can help and figure them out, as well as how they're appropriate for different investing goals. So I know you're sticking with us because I'm going to lock the door. We'll see everyone in 3 minutes, and we'll get more into it. Thank you.
Don't turn that dial. We will be right back.
Are you tired of dealing with unreliable banks and brokers who charge upfront fees and never deliver on their promises? You don't have to. Gelt Financial Corporation has been in business since 1989 and offers a stated income loan program for non-owner-occupied residential and commercial real estate investors. No tax returns required. What are you waiting for? Call Gelt Financial right now at 561-221-0900. Again, that's 561-221-0900. 561-221-0900.
Did you invest in a non-liquid real estate partnership? Do you want and need liquidity? There's finally an answer. Quick Liquidity is a direct buyer of real estate minority interest and tenants in common investments across the country. To find out if we would buy your non-liquid investment, call us at 561-221-0881 or visit us at quickliquidity.com. That's quickliquidity.com.
Welcome back to It's Down to Business with Jack Miller. Call us at 305-541-2350. Follow us on Facebook at Jack Miller Down to Business or on Twitter at H.Jack Miller 1.
Chances to serve.
Hello, everyone. This is Jack Miller on a beautiful day with my main man, Todd Cohen. Todd, we are jumping into really good stuff, and this is what we do for a living.
This is an extended commercial corner. I've been waiting, a couple months for this. It's nice to sort of get back to our roots and talk about this. Look, to our listeners, there's a reason YouTube is so effective. And when I get together with a client, with anyone, I use show and tell methods because it's a lot easier.
Todd, what are you showing and telling? I'm joking, and I had to go for that. I had to keep it a little dirty.
You have to pay a premium for those channels, Jack.
I do.
Come on, no, seriously. I get together and I walk people through a lot of these analyses. It's conceptually, it's a lot more difficult to just use words. Pictures worth 1,000 words, as they all say, and there's a lot of numbers and topics that we're covering here that may not translate so well to the radio, but our faces do, which is great.
A couple other points I want to make before we get into it. We're talking about the measurements in a real estate investment, or really any investment, and the differences between cap rates, return on equities, IRR.
Right.
And today, there are very sophisticated tools out there, effectively souped-up spreadsheets that you can play with scenarios, what-if scenarios, very easily. So I would recommend anyone who has a property who wants to know their real returns or their investment goals, they contact Todd And
Sure.
they give him the information. You could be in Hawaii, and Ty could do a spreadsheet and email it to you, and it's pretty easy to play with what different scenarios. If the property appreciates this much, if the rents go up or go down, and things like that.
Sure, right. And I bring other metrics into it. I bring neighboring properties and what the rental market's like. I bring, recent sales, like-kind sales, so that everyone's on the same page in terms of, why I attribute certain values, certain rates to the equations.
Walk me through how an investor in different scenarios would be more concerned with, for example, a cash return or an IRR.
Got it.
Based on their own goals.
Well, look, if an investor is looking for stable cash flow or a real cash flow over a time horizon, then they're going to be more, inclined to look at a cash-on-cash return, a return on an equity return, and cap rates. That's always important. Whereas an investor who's just looking for, a return over a time horizon, whether it comes in the form of cash flows along the way or whether it's just a big pop at the end upon sale, that investor is probably going to be more focused on IRR. There are many different types of investors out there. I'm simplifying this very much, but in general, that's the case.
So let me give 3 examples, and they're the extreme, but they're really real-life scenarios that I'm working on now.
Okay.
On one particular deal I'm working on, the investor's coming up with money, and all they really care about is the cash return. How much are they getting every month or every year on their cash return?
Right.
They're not factoring in IRR, future sale volume, or they're not factoring in debt repayment. So in other words, to them, to get a number of, I'm making this up, the number of $10,000 a month is very important. They don't care that the debt is being paid by X down. All they're motivated is by cash return because they need that money to live and survive on. So that's investor A. So that's the cash return. I have another, it's actually a fund that really doesn't need the cash monthly or annually. All they care about is debt repayment. So they don't care about a monthly or quarterly or annually return. What they're interested in is their rate of return, and they're much more interested in paying down the debt much quicker.
Okay.
So that's a different type of investor.
Right, but it depends how they want to pay that down and how they want to structure it, because some investors like that might want a preferred return, and then anything above and beyond that.
What this particular fund, it's a very old fund that buys credit tenant deals. They have plenty of cash. I don't want to say too much cash, but they're interested in safety. So for them, they're willing to give up all distributions and pay off the debt on a commercial property, and they're buying Walgreens, KFC, CVS types in 10 years. That's their goal.
Okay.
They don't care about putting a penny in their pocket. Then I have another, just put a very big deal together. It's almost close, so I don't want to give myself a jinx. They're an IRR fund, so they really don't care as much about the long term. They want to buy the property on a Monday, literally sell it on a Tuesday, because they're IRR driven, which is internal rate of return.
Right.
So there are 3 different scenarios, totally different. And coincidentally, I work with them all. And I think it just illustrates that everyone has different goals, and one pot doesn't fit. What's the expression? One thing doesn't fit everyone's needs, or whatever it is.
Right. Look, I mean, I work with all different types of clients as well. Clients who, are mom and pop owners who have one property and they manage it themselves, all the way up to, mega funds, REITs, pension funds, and that type of investor who, are extremely sophisticated, are IRR driven. They have, millions of square feet of real estate all over the world. And it doesn't really matter. You need to sit down with everyone and find out what their goals are. That's very important, just as you mentioned, and really find out how you can add value to that, okay? Because there are different ways along the way that you can, and that's what we both do. We work from sort of different opposite ends of the spectrum in doing that, but we really can add value. You add value in a lot of providing liquidity matters, advisory matters, and I do so from a different standpoint, but advisory as well. But, it really is important, especially if you're interested in real estate, if you already own real estate, to sit down with someone like us and talk about that.
And I think it's important that everyone understands their individual goals before they really start looking, because some people are attracted to higher cap rates, but they may not be interested in the other goals. Everyone's goal is different, and they really have to know their goal before they identify the property, because certain matrices may not be appropriate. They may not care about an IRR.
And more to that end, when looking at cap rates are based on a few different things, okay? A given cap rate, which is the yield you should expect to return on an investment you make, it's really the risk of an investment, and that's sort of what informs what a cap rate would be, okay? And what changes the risk of an investment is the credit behind the lease or leases, how trustworthy or creditworthy is the company or person that is leasing the space. Number 2, the duration of the lease or leases, okay? And number 3, as always with real estate, is location, location, location. Okay, and the risk of an investment is based primarily on those 3 things, whether it's 1 tenant or 100 tenants, and no matter where the property is located. And that will inform what the cap rate you would expect to pay would be. You'll have a much lower cap rate or expected yield if any of those, if all of those boxes are checked as great. Okay, you have a very long lease, a very creditworthy tenant roster, and an amazing location. You're going to get a very low cap rate.
So it's risk reward.
Sure, and you're going to have a very high cap rate if all of those things are horrible. I mean, if you have no credit on the leases, if you have a poor or risky location in an undesirable location, let's just say, and if the creditworthiness of the leases is and if the time remaining on the lease is short to non-existent, let's just say it's a month-to-month lease, you're expect a much higher rate there.
Gotcha. So it's risk reward, and really what someone should do is contact you and go over their personal needs and kind of measure up. And I know you can send them all kinds of report and work it back and forth.
That's right. And my name's Todd Cohen. I'm with Marcus and Millichap. We're one of the largest, we're actually a public company. We help people who own real estate in all the major asset classes all over the country. And it doesn't matter what size, who you are. But we help people who are looking to invest. We help people who already own the properties. And, again, you can find me on our website. My phone number is 786-522-7021. And you can go to marcusmillichap.com. And I'm happy to help.
And Todd will give you all the information. This is Jack Miller. You can always reach me at jackmiller@geltfinancial.com. Todd, we only have a minute left. What do you think of the Iran deal came to conclusion this week, I guess, and the hostages?
Not a fan.
You're not a fan?
Not a fan. But, look, I'm always glad when an American or any other lives are freed who have been taken hostage. So on that, from that perspective, of course I'm a fan. But yet again, we're negotiating with terrorists, and I don't think we're getting the fair end of the bargain in any shape or form. I don't think we did with the nuclear deal. I don't think we are yet again with this. There's a big election coming up. I think that this is another, depending on how you look at it, either a victory for Obama or a scar on his resume. And I don't think that stuff like this is going to change people's outlook on that, because people's minds are already made up. We're very polarized in this country.
Did you see I think it's called 13 Hours at Benghazi yet?
Yeah.
Oh, was it good?
It was very good.
I saw a clip on it last night. I can't wait to see it. Hopefully this weekend.
All this stuff makes me nauseous. Well, I mean, our world is disgusting.
I stopped watching the news anymore.
Right.
I get too depressed. Literally, I get
might
too
as well
depressed.
Watch a horror movie.
I watch others.
It's more uplifting.
Yeah, I watch like Austin Powers and The Night at the Roxbury and stupid movies to put me in a good mood.
Well, that's what you should do.
I try to. The news is way too depressing. Way too depressing.
Right. Look, I mean, I don't know what to say. I mean, it's been a couple weeks to start the year of bad news. We had some major deaths in the world of music. David Bowie, Glenn Frey. I mean, I love, both of their music. They're not my two favorites, but I love everything that they did. I like what they stood for. They're great losses in the world of music. I think that, I'm going to mourn them.
Well, with that, we want to give condolences to the Fry family and the Bowie family. Chose out of it. And everyone, thanks for joining us on another great show, and we will see you next week. And check us out. We have a new website. I didn't even talk about it, hjackmiller.com. It's 90% there. Let us know what you think about it, everyone. Have a great week. Thank you.
Bye, everyone.
We hope you enjoyed the show. Don't forget to tune in next Thursday at 3 o'clock on 880 The Biz. If you want to send in your questions, comments, or ideas for shows, please email Jack Miller at geltfinancial.com. Follow us on